You want to know the truth? Most investors don't lose money because of bad markets. They lose because they're trying to play checkers in a chess game. They blame the economy or interest rates or black swans. But the reality, it's not the storm that sinks the ships. It's the hole they never saw. And trust me, I know because I've been on both sides of that table. Before founding Infinity 9, I built and exited a business from scratch. And all my liquidity, every dollar, went straight into real estate. Not because I wanted to get rich, but because I wanted safety, reliability, and leverage without chaos. What I found was shocking. Even among wealthy investors, even inside family offices with teams and advisors, I saw the same patterns repeat. They lose money because they underestimate three things: people, structure, and timing. And here's the most painful part. Most of these losses were entirely avoidable. I spent the last decade reverse engineering how to protect capital at high level, not just grow it, protect it, because in the long run, risk management is your return. At Infinity 9, we developed a process that filters out noise, highlights the red flags, and gives investors the discipline and clarity they never got from Wall Street or their cousins, multifamily deal in Texas. This isn't theory. This is a method we use to underwrite and structure every investment we bring to our investors. It's how we walked away from glamorous branded Miami condo development that dozens of others piled into, and how we avoided the losses of the dealings that we are right now. So today, I'm going to walk you through these three silent killers of investor capital, show you how to exactly we've learned to catch them in advance, and give you the new lens for protecting your wealth like the 0.01% do. This is not a pitch, it's a discipline, a practice, and a mindset. It's how we operate at Infinity 9 and how our investors sleep at night. Let's begin with the first and most underestimated reason investors lose money. They trust the wrong people. I've said this before and I'll say it again. In real estate, the most dangerous risk isn't the deal. It's the person behind it. The sponsor, the operator, the manager, the human. And yet investors will obsess over cap rates and rent comps, but barely scratch the surface on who's they're wiring their hundreds of thousands of dollars to. I call this credential blindness. We assume that because someone has a nice deck or a nice watch or a few closed deals, they must be capable. But here's the truth. Track record is not the same as battle-tested discipline. At Infinity, we treat sponsor vetting like a forensic audit because we've learned, painfully, that how someone made money is more important than how much they made. Did they win because of the rising market or because real operational skill? Did they navigate a downturn without panic or get lucky in timing? Here's what I do differently. We start by investigating how they behaved in hard market, not just what they made in the good times, but what they protected when things got tough. We run background checks, legal, financial, and operational, litigation history, bankruptcies, quiet investor disputes. You'd be shocked how many successful sponsors have skeletons. We talk to prior LPs and ask a simple question. What surprised you after you invested? That one answer reveals more than a 20-page deck ever will. And here's something few investors think about. Incentives. What's driving the sponsor to win or cut corners? We walked away from a deal with front-loaded fees, short-term payout pressure, or vague alignment. Because if the person you're trusting with your capital gets paid whether you win or lose, you're the product, not the partner. There was one deal we considered in a booming southern city. It looked great, it had healthy margins, it was branded sponsor, but our diligence calls we heard 3 LPs prior mention the same phrase. Great guy, but he ghosted us when things got tight. That was all we needed to know. No matter how good the spreadsheet looks, if you cannot trust the operator in a bad weather, we don't board that ship. And neither should you. But trust isn't enough, because even with the right person, the wrong structure can still sink you. Let's talk about the second killer, how deals are structured. Most investors don't realize this. But the same deal with the same sponsor in the same building can either be safe or suicidal, depending on how it's structured. Let me explain. Structure is the invisible scaffolding of every investment. It determines who gets paid first, who takes the hits, and who holds the bag when things go sideways. It's not what's on the pitch deck, it's what's behind it. And this is where even experienced investors lose money, not because the deal was bad, but because the capital stack was quietly stacked against them. Let me walk you through this and how it works. The lie of the same deal, same risk. Imagine this. You and I both invest in the same apartment complex in Atlanta. You invest as preferred equity, I invest as common equity under the GP. Same asset, same sponsor, same plan. But if something goes wrong, say rent growth underperforms or construction delays, you're sitting above me in the waterfall. You get paid first. I take the hit. That's not a minor detail. That's the entire game. And yet, most investors I meet never ask, where am I sitting in the capital stack? Who's senior to me? What triggers a distribution? What happens if something goes wrong? What we do differently at Infinity 9, we obsess over structure. Because I've seen great deals, strong markets, solid sponsors still lose money, simply because investors were in the wrong seat of the plane. Let me give you an example. A few years ago, we looked at a beautifully located retail center with a high-quality anchor tenant. The sponsor was credible, the market was appreciating, everything looked tight. But we dug into the structure, we found something that made our stomach turn. The sponsor had slotted LP capital behind a large mezzanine lender and structured their own GP promote to get paid before LPs hit return thresholds. If the project performed okay, the sponsor still won. The investor got crumbs. We passed immediately. And here's the twist. That deal still did well on paper, but every investor we spoke to afterwards told us the same thing. We made less than expected, and the sponsor made more than they deserved. I don't think that's partnership. That's a trap. How we use structure to protect capital and flip the whole game onto them. Here's how we structure investments for ourselves and our investors. And it's called clear downside protection. If it's preferred equity, we negotiate for hard pay provision, not soft pref. Meaning we get distributions before the sponsor sees a dime. No gains. Alignment of incentives. We avoid front-loaded fees. We prefer back-ended promotes that only kick after we hit our agreed returns. We should never be paying someone before they've created value. Second, risk-adjusted positioning. We evaluate where our capital sits in the stack. If we're talking common equity risk, we demand common equity upside. If we're taking fixed return, we demand seniority. Third is exit triggers and control rights. Every deal we participate in is structured with clear exit triggers. Either it's refinancing, capital events, change of control provisions. And where possible, we negotiate the right to intervene if something goes off track. Let me say this clearly. The structure of the deal is more important than the pitch of the deal, because when markets shake, and they will, terms are what protect you. It's not hope. There was a deal in Miami that got passed around like candy. It was glamorous, high-rise condo, branded sponsor, prestige location. The deck looked impeccable, and it was made by an architect or a fashion designer. It was really good. But when we read the fine print, it was horrifying. The LPs were subordinated to multiple layers that the sponsor was charging development fees, acquisition fees, asset management fees, and a promote, all stacked up front. In effect, the investors were taking 90% of the risk and maybe 40% of the upside. And guess what? The sponsor had never built a high-rise before. Everything about the structure screamed, we want your capital, not your partnership. We walked, even though everyone else piled in, and let me tell you, it felt like a mistake at the time. We want your capital, not your partnership. We walked, even though everyone else was piling in, and let me tell you, it felt like a mistake at that time. because the sponsor was super hot, the branding was sexy, the market was moving. But 18 months later, we saw those same LPs facing cost overruns, delays, capital calls, and the return profile that no longer worked. Structure isn't sexy, but it does save lives. Most investors lose money not because the building failed, but because the structure failed them. So the next time someone pitches you a great deal, don't just ask what the deal is. Where do I sit? When do I get paid? Who gets paid before me? What happens if we're off plan? And if you don't get clear answers, walk away. Because as we say inside Infinity 9, returns are not what you hope for. Structure is what you control. So if you got the right sponsor, you've negotiated a fair structure, you're in. But one final risk still remains, and this one doesn't show up on any spreadsheet, and it's timing. There's a phrase I hear all the time: we're in it for the long term. It sounds smart, responsible, mature, but most of the time, it's just a poor way to justify timing decisions. Because here's the truth nobody likes to admit: even long-term investors can lose money if they enter at the wrong time or exit too late. Timing isn't about trying to time the market. It's about understanding where you are in the cycle and how long you're positioned to survive. And most investors, they're not late because they are dumb. They're late because they're optimistic. The mirage of forever investing, real estate always goes up, it's the most dangerous sentence in investing. Yes, real estate can be an incredible long-term wealth builder, but timing determines whether you get wealth or lessons. Let me give you a simple metaphor. Imagine you're holding a world-class surfboard. Now picture a beautiful wave forming in the distance. If you paddle too early, you miss the momentum. Too late, you get swallowed. It's not about how good the board is, it's how well you've read the wave. This is how much we spend time analyzing macro signals and local catalysts as we do underwriting the property itself. Because what looks like a deal at the top of a cycle often becomes a problem halfway through. Timing risk shows up in quiet ways. It's not just about buying high, it's about assumptions that silently break when every cycle shifts. Let me give you a few examples. Underestimating lease terms and timelines. A sponsor assumes that they can lease a property in 12 months, but the local market softens. Now it takes 20 months, and suddenly your IRR falls off a cliff. Refinancing assumptions. A deal underwritten in a 4.5% refinance rate suddenly faces a 6.25% debt market. The DSCR doesn't pencil. You'll either inject more capital or accept a fire sale exit. Construction delays and rising costs. Even a 3-month delay can erode profit if your interest carry burns too hot. In a volatile market, time becomes your enemy. Every week you hold that asset, you're either compounding your returns or bleeding them. And most investors, they don't even know which one they're doing until it's too late. How can we mitigate the timing risk at Infinity? We don't believe in crystal balls, but we do believe in discipline. Here's how we reduce timing risk consistently. Number one, we do Monte Carlo simulations, which is a stress test of reality. Most underwriting shows one outcome. We simulate thousands. We change the inputs: lease rates, exit cap, construction costs, interest rate, absorption. We look at not just the expected return, but the range of outcomes and how often they dip below our safety floor. If the downside scenarios look survivable, even profitable, we proceed. If they don't, we walk. The second way is to have proactive exit triggers. We don't wait and hope. We define in advance what signals an exit and refinance or a strategic pivot. And it might be hitting 90% occupancy. Reaching DSCR stabilization is another one, or a shift in the Fed's forward guidance. And here's the difference, because we've been through it, and when we don't hesitate when that time comes. 3, conservative entry assumptions. Most investors model today's rent and tomorrow's optimism. We underwrite 3 steps behind: conservative rent growth, extended lease-up periods, higher exit cap rates. Why? Because if we were wrong, we want to be wrong on the side of safety. 4, liquidity buffers and rate cap hedging. We don't just want to assume market conditions will hold, we prepare for when they don't. Case in point, we once had a multifamily deal with floating rate debt. The sponsor didn't want to buy a rate cap, said it was too expensive. We insisted, and 2 months later, interest rates spiked. The deal would have gone negative on cash flow without that cap. That one hedging decision saved the investment. There was a well-known deal in 2022 that many investors jumped into. It was multifamily development in downtown location with big brand behind. But we paused. Why? Because we saw the leading indicators. Oversupply of competitors. Construction costs were climbing. Debt spreads were widening. The sponsor was still pricing the deal like it was 2021, but we were looking at 2023. They assumed a 24-month turnaround, and we knew it would take more than 36. We didn't touch it. And 18 months later, they're facing cash flow gaps, a stalled project, and a bridge loan they can't refinance. This is what timing really means. Not just when you enter, but how much time you have to survive. So, how do investors really lose money? They enter at the wrong time with optimistic assumptions with no margin of error, and then reality shows up. It's too late to restructure, too late to exit, too late to protect capital. At Infinity 9, we believe in something simple. You don't need perfect timing. You need durable positioning. That means entering with margin, exiting with discipline, and never confusing the market cycle with your personal timeline. I want to share something I've never talked about publicly. The hardest investing lesson that I've ever learned. It cost me time and trust, and it built the foundation for how we invest today. Because before I ever built this framework, I made almost every mistake we've talked about today. The one that changed everything, it's personal. So let's go there. I want to tell you about a deal I usually don't talk about. Not because I lost millions, but because I almost lost myself in the process. It was early in my real estate career. I just exited my business. I had fresh capital, and more importantly, I had conviction. I believed in numbers, and I believed in the thesis, and I believed the person who brought me the deal. It was a boutique multifamily in a fast-growing city with charming units, walkable neighborhood, upside on the rents, and the sponsor was someone I knew through a network. Credible, charismatic, and quick. He told me all the right things. He showed me the deck. He shared how much of his own money he was putting in, and I believed them. The problem wasn't the building, it wasn't the market, it was the structure, and it was me. Because I didn't ask the hard questions. I didn't confirm what skin in the game actually meant. I didn't push back on the aggressive lease-up schedule. I didn't notice in the waterfall that the GP got paid before the LPs had ever even cleared 8% return. I was focused on the opportunity and I ignored the architecture. And when things didn't go to plan, which in real estate is the default, everything cracked. The construction dragged, the rents didn't grow, the refinance window closed, and the sponsor, he didn't know what to do. It wasn't a blowout, but it was just delay and excuses. And I remember sitting at my desk reading the investor update, realizing I don't control a single lever in this machine. And worse, I couldn't even explain to my wife what had gone wrong because I didn't even know myself. That experience hurt, not just financially, although the return ended up flat at best. It hurt because I realized I outsourced my responsibility. I trusted someone else to care about my money more than I did. And that's the thing that changed. That's when I started building I trusted someone else to care more about my money than I did. That's when everything changed. That's when I started building a different framework. One rooted in structure, not story. One that stress tested every assumption. One that treated timing, people, and risk as first-class citizen, not footnotes. That mistake became my origin story. It was the moment that I stopped being a participant and I became a capital allocator. So if you've ever made a mistake in investing, you're not alone. The trick isn't avoiding pain, it's extracting clarity from it and using that clarity to never make the same mistake twice. Because when you build from pain with discipline, that's how wealth becomes resilient. That moment, sitting at my desk, realizing I had given up control, that day I stopped chasing the upside and I started engineering protection. And everything you've heard today, it came from that moment. So now, let's pull it all together, not just as a framework, but as a philosophy. We've covered a lot today. And if you made it this far, you're not here by accident. You're someone who's just on their way to make money. You want to understand it, protect it, multiply it with intention. So let me bring this full circle. The real game investors should be playing, most people think investing is about returns. That's not wrong, but it's not complete. Because wealth isn't what you make, it's what you keep and how well it compounds. And these three lessons investors lose money: people misjudging the sponsor, structure, not knowing where they sit in the stack, timing, entering with optimism instead of strategy. All three of these are completely avoidable if you have the right lens. Not a better forecast, a better framework. That's what we built at Infinity 9. It's not magic, it's not predictive, it's a disciplined way of saying, even if I'm wrong about the future, I still protect the present. What this means for you, you don't need to become a full-time investor to protect your capital, but you need to upgrade your questions. Instead of what's the return, start asking what could go wrong and who absorbs it. When do I get paid and what has to happen first? How does this deal behave in a storm? Because the people who build real wealth don't chase upside. They minimize regret. At Infinity 9, we work with investors across Latin America, the Middle East, and the US. People who've built wealth the hard way and want to protect it in a smart way. We built our process not for institutions, but for people like you, entrepreneurs, family office, first-generation wealth creators, people who care more about preservation than the pitch decks. If that resonates, there are two paths from here. Take the principles we've shared and apply them. Use what you've learned and ask better questions. Build stronger filters and stay skeptical of sexy narratives. Or if you want to partner up with someone who lives and breathes this discipline every day, reach out quietly, privately, no pressure, no pitch. Either way, I want you to win, because the more thoughtful capital we put into this world, the more resilient our families and our legacies become. One of my mentors once told me, the most powerful wealth isn't loud, it's quiet, consistent, and hard to break. That's the kind we build here. And if that's what you're building too, we're already speaking the same language. Thanks for watching, and I'll see you at the next one.